2024 has been an interesting year for the economy. The stock market has been booming, crypto prices have been skyrocketing, and housing prices keep going up. So on one hand, you have investors who are getting richer than ever, but then on the other hand, the average American is getting poorer. Americans aren't getting pay raises like they were before, bankruptcy filings are rising, and more Americans are turning to their credit cards to pay for their groceries. That's why I call it a tale of two economies, because you have two stories that are playing out. Over the last 5 years, the average American who's relying on their salary has only seen their income rise by 20% over the last 5 years. It's actually under 20%, but I'm rounding it up to 20%. While at the same time, the prices of things on average have grown by 23%. That is the reported inflation numbers. Not to mention that housing costs have actually risen by 50%. Car insurance prices are up by more than 50%, but the reported inflation numbers say the prices of things have gone up by 23%, while the stock market has risen by around 90% over the last 5 years. So investors are getting wealthier, the average person is getting poorer, and most people have no understanding of why. That's why as we're entering 2025, I want to go over what's happening in our economy. More specifically, I want to talk about 5 things. Number 1, I want to give a broad update on what's happening in our economy today. Number 2, I want to talk about what's going on with inflation. Number 3, I want to go over what's happening in the job market. Number 4, I want to talk about what's happening in the stock market and what to prepare for over the next 12 months. And number 5, I want to talk about what's happening in the housing market. So you definitely want to stick with me through the end of this video. And as an added bonus, on January 7th, 2025, I'm going to be hosting a live wealth building workshop on what you can do to build wealth, invest your money, and find investment opportunities in the new year on January 7th. I'm going to be hosting 2 live workshops on January 7th. One is going to be in the morning at 10:30 a.m. Eastern Standard Time. The second is going to be at 8 p.m. Eastern Standard Time. We're not going to have any recordings because my tech person is going out of town. But if you'd like to join, it is completely free, it's virtual, and we have a ton of concepts that I'm going to be going over, plus a little surprise at the end as well. So if you'd like to join me on this free workshop on January 7th, 2025, and see how you can build wealth in the new year, you can join me, but you have to register. I got the link to how you can register for one of the workshops down in the description below. Let's start with what's happening in the economy. According to the latest economic data, our United States economy is still strong because Americans are still spending money. Now remember what I showed you earlier. The average American hasn't seen their income keep up with the price growth of things. Well, the economy doesn't care if you're spending debt or the money in your bank account, because money spent is just money spent. If you're spending debt, that's your problem. And this is where what we're seeing happen is Americans are spending money that they don't have. Buy now, pay later companies are getting more Americans to change their spending habits, and more Americans are turning to credit cards. So the data says our economy is booming. Our economy is measured through a number called GDP. GDP is a measure of all spending that happens in our economy. Now, in the GDP, they don't care if you're spending your money or if you're spending your debt. And what we're seeing is many Americans are depleting their savings to spend more money, and Americans are turning to buy now, pay later. They're turning to credit cards to spend debt. But there's one more part to the GDP that is often overlooked, which is contributing to the growing economy. And that is the biggest spender in our economic system, which is not Apple, which is not Amazon, which is not Tesla. It is none other than the government, because we're also seeing a national deficit boom happen in the economy. Our national deficit means that the government generates tax dollars, and then they spend more money outside of those tax dollars that they collect. That's the deficit. They're spending money that they don't have. And in 2024, we're expected to have the 3rd largest deficit in the history of time. It's only after the pandemic, which might seem a little bit strange, because during the pandemic, the government was spending money to stimulate the economy, to get us out of the pandemic and all that. But here we are in 2024, we talk about how we have one of the strongest economies of all time. So why are we seeing such a large increase in deficit spending? Now, unfortunately, I don't have a good answer for that. But what we do know is that this deficit spending that we're seeing is also contributing to the GDP, because government spending is a part of the GDP. So this government spending is contributing to the growing economy. But despite all of that, you are starting to see some people that are moving away from this economic euphoria saying, maybe there is some concerns in this economy. For example, between 2023 and 2024, we have seen bankruptcy filings in America rise by more than 16%. Not to mention, we've also seen an uptick in layoffs in 2024. Now, so far, this has not caused any pain or concern to the GDP or our economy. But the question is, will this trickle to something bigger? And the answer is, nobody knows. We know the economy goes up and down. We know that our economy goes through recessions. We know that our economy has seen 16 recessions over the last 100 years, but nobody knows what's going to happen in 2025, which is why you just want to have a broad picture of what's happening. That way you can find the best investment opportunities, which I'm going to get into in just a little bit, which brings me to part 2. What's happening with inflation? The Federal Reserve Bank is the central bank here in the United States, and they're one of the main entities in charge of trying to manage inflation. And what they have said is that they want to see inflation fall to 2%. And you might wonder, well, why 2%? Why not 1%? Or why not 0% inflation? And the reason why is because 2% inflation is low enough that the average person doesn't see it day to day, but that inflation also benefits investors. But that's a topic for a different video. The key thing that you want to pay attention to when it comes to inflation is that inflation is not falling directly to 2%. In fact, just a month ago, we saw inflation rise, not fall. So the question is, where is inflation going to go next? Now, I'm not a financial advisor and I'm not an economist. I'm just a random guy on YouTube. So I have no idea what inflation is going to do next. But what I do know is which factors impact inflation. I'll keep this very short. This is you. You go to work every single day to get paid, and then when you get paid, some of this money goes to the government in the form of taxes. By the way, for our male followers, I drew you a mustache, or my native language Punjabi, we call that a much. And for my female followers, I drew you a braid, which in my native language Punjabi, we call a gut. So you go to work every single day, and you make money, then you pay the government in taxes. Now the government is going to go out, and they're going to spend this money in the form of whatever they want to do. Maybe they're going to build bridges. Maybe they're going to invest in the military. Maybe they're going to invest in teachers. They're going to spend money. And then if the government decides to spend more money than what they generate from taxes, they're going to continue spending this money. And there's two ways that they can go out and raise this money. Either they can ask you to pay more money in taxes, which they're going to have to get approved from Congress, or they can just spend the money and then figure it out. And what we've been seeing happen more and more is that the government just keeps spending this money and then figuring it out. Which might have you wondering, well, if the government has this very large national deficit, meaning the government is spending all this money without these taxes, why do you have to pay taxes in the first place? Well, there's a consequence to the government spending money without the taxes. Because if they're paying for the military, if they're paying for healthcare, if they're paying for a bridge, the money still has to come out of the government's bank account. And they need those dollars there somehow. And if they don't have the money from taxes, that's where they turn to their friends at the Federal Reserve Bank. Now, I said just a minute ago that they're the central bank in the United States, but the interesting thing about the Federal Reserve Bank is that they're not federal. It even says so on their website. They're not a reserve. They don't sit on any cash reserves. And they're not a bank. You and I can't go there to deposit money. But one of the abilities that the Federal Reserve Bank has is they have the ability to poof and print money out of thin air and then lend this money to the United States government. That way the government can then spend this money however they please. Now I'm going to go back to the original question. If the government can spend this money without the tax, why do you have to pay taxes in the first place? And the reason why is because when they do too much of this, printing money and spending money, this can then create inflation. Because remember, these dollars are not backed by physical gold. It's not backed by any precious metal. It's just a piece of paper. So when the government is spending money that they don't have, this then dilutes the value of each individual dollar, which then causes the prices of things to go up. This is the inflation. Many people say inflation is the prices of things rising, when inflation, the core definition, is increasing the monetary supply. It's increasing how many dollars are out there. So when you hear the government is spending money, that is a form of inflation, especially when the government is spending money that they don't have, because then this money has to get created through an entity like the Federal Reserve Bank. And this brings us to number 3, what's going on in the job market. And now you're going to start to see how all this ties into one another, especially as we get into the housing market, because this is all going to become one big jumbled mess, but we'll get there in just a minute. According to the raw data, the job market is booming. We are still seeing historically low unemployment, and the amount of job openings available are also rising. So let's start piecing this puzzle together. The data says the economy is booming because people are spending money, people are spending debt, and the government is spending money that they don't have. We've already established that. And now the job market data also says that the job market is booming. Now remember, what causes the job market to boom? Well, if the government is spending money, let's say on building a road, they have to hire contractors, they have to hire construction companies. So the spending is good, not just for the economy, but also good for the job market, because when the government spends money, somebody has to be employed to use that money. Likewise, when you walk into Chipotle and you're buying the extra guac on your Visa because you don't have the money in your bank account, well, that's good for Chipotle, which gives them more money to hire their employees. But here's the problem that we're starting to see. First, if you ask the average person, they will tell you that it is very difficult in today's job market to find a job. Now, it's not for everybody, but for many people, finding a good job is still difficult. Part number two, if you were hoping to get a raise to fight the inflation that we've been seeing, well, your chances of getting a raise have just fallen. This is a chart by the Federal Reserve Bank showing wage growth in America, and you can see that wage growth has been cooling pretty steadily since 2022. Third, if you're switching jobs, trying to get a pay bump, well, you're less likely to get that pay bump that you would have gotten before. And of course, number four, companies are also beginning to crack down because they're also seeing the changes in the economy, so companies are becoming more strict on underperformers and mandating return to office. So according to the data, the job market is booming. And the reason why the data matters is because the Federal Reserve Bank, which is the entity in charge of trying to manage inflation, is looking at the data as they're trying to figure out what they're going to do to manage inflation. But a lot of people who are actually in the job market are saying the data that you're seeing in the job market is not the job market that I'm seeing. That's why that data matters. Not because those statistics really mean anything to you, but because the entities that are in charge are looking at those statistics to change the monetary policy in our economy. Which now brings us to number four, but I do want to hear from you. What are you seeing in the job market if you're looking for a job? Has it been a good job market or bad job market for you? Let me know down in the comments. But this brings us to number four, what's going on in the stock market? And yes, we cover all of this in Market Briefs, which is my free financial newsletter. If you have not joined Market Briefs, it's completely free, and I have that link for you down in the description as well. The stock market is up around 30% year to date at the time of me recording this video. And some of the more recent gains that we've been seeing in the stock market have been people on Wall Street excited about the Trump presidency and what he's going to do to keep the stock market booming in 2025. And this is where everybody's trying to predict what's going to happen next in the stock market, and the reality is nobody knows. Now, I already gave the disclaimer that I'm just a random guy on YouTube, but I have to also remind you that investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence. Never blindly trust a random guy on YouTube. But this is where I want to give you a little secret that for the average person, in fact, for 98% of people, what I say is you should just be a passive investor and not trying to find the next hot stock, because the average person doesn't have the time to do the research. They don't want to do the research. They don't care about the research. They don't understand the financial statements, which is fine. And if you don't want to do that, the way that you win is not trying to predict what's going to happen in the stock market next year, even though that's what everybody's trying to do. But what you should be doing instead is what I call ABB. Always be buying. You find a broad index, maybe the S&P 500, maybe the total stock market. There are funds out there that will let you do this. I'm not telling you what to invest in. Here's an example. SPY. This is an ETF that gives you exposure to the S&P 500. This is a group of the 500 largest companies in the stock market. VTI is an ETF that gives you exposure to the total stock market. So when the stock market goes up, VTI is generally going up. When the stock market's going down, the total stock market, VTI is generally going down as well. Now, you don't have to worry about trying to find the next hot stock. You don't have to worry about trying to find the next Amazon. You just do ABB. You buy when markets go down, you buy when markets go up, and you keep buying when markets are sideways. It doesn't matter if it's raining outside. I don't care if you own a cat or a dog. I don't care if you voted for Harris or Trump. I don't care. ABB is the way that you win over the long term. And then what's going to happen, I'm going to tell you right now, that way when something bad happens, you can look back at this. We're going to see a crash. We're going to see a recession at some point. And markets will fall. And when they fall, people are going to panic. People are going to lose their minds. People are going to say investing is a scam. The whole market's a scam. It is rigged. Wall Street is pinned against the average person. These Wall Street banks are getting bailed out. The average person gets screwed. That will happen again. Okay? But the way that you win is you stay patient, you stay calm, and you keep buying through those weeks, through those months, and maybe through those years. Because what we have seen over the last 100 years is that we have seen 16 recessions over the last 100 years. We have seen many market crashes, we have seen many economic downturns, but despite that, the stock market in whole has grown by around 10% a year on average. Does that mean the stock market always grows by 10% a year? No, 2024, it grew a whole lot more. Does that mean that the stock market's always gonna rise? No, the stock market crashed in 2008. The stock market crashed for a little bit of time in 2020. But over the long term, when you average out the booms and the losses, the stock market over the last century has risen by around 10% a year. Yet many people lose money when they invest their money in the stock market. And the reason why is because they're buying when everybody's getting excited, they buy when everybody is winning, and then when things start to go down, they panic, they cry, they scream, they say everybody's against them, they say it's a scam, and then they sell. They're buying high and selling low. And this is where, if you don't want to be that involved in the market, that's okay. ABB, always be buying, and you just keep buying when markets are up, you keep buying when markets are down, and you just let the emotions do their thing, and you hold on for the long term. That's where the real wealth is built. And now let's tie this whole video together by talking about what the heck is going on in the housing market. The most recent data that we have gotten says that home prices are still rising, although they're rising not as fast as they were before. Now, the reason why I said earlier that all of these factors tie into one another is that one of the biggest factors in the CPI data, the inflation data that we get, is the housing market. And according to the Federal Reserve Bank, one of the factors that are making it so difficult for inflation to come down is housing costs, rental costs, because housing prices and rental prices have gone up so much and they're not coming down, making it difficult for inflation to cool down. And the reason why that matters is because even today, housing prices across the country are still rising. Does that mean that they're rising in every neighborhood? No. Real estate is very localized. Some neighborhoods are falling, some neighborhoods are stable, but overall, as an average across the country, housing prices are still rising at the time of me recording this video. So earlier when we were talking about how deficit spending can make inflation worse, another thing that's also hurting inflation is the housing market. And the reason why all this ties in together is because the Federal Reserve Bank is the entity that's in charge of managing interest rates. Not mortgage rates, but interest rates. These are the interest rates that banks pay to borrow money, which can have an impact on the mortgage rate that you pay when you go out and buy a house. Now, when the Federal Reserve Bank is deciding what they want to do with interest rates, the two factors that they're paying attention to are right here. They're taking a look at inflation and they're taking a look at jobs. This is because the Federal Reserve Bank has what's called a dual mandate. They're supposed to take a look at two things: price stability, meaning inflation, and maximum employment, meaning the job market. So they're looking at the data that I showed you. And based off of that data, they decide what to do with interest rates. And right now, everybody keeps saying that the Federal Reserve Bank is going to continue cutting interest rates because, well, they want to keep working on this job market and inflation's not a problem. So they say that they feel comfortable continuing to cut interest rates. But if you continue to cut interest rates, that gives more breathing room for banks to potentially lower mortgage rates. It doesn't directly cause mortgage rates to fall, but they can give a little bit more breathing room to potentially bring down mortgage rates. Well, the problem with that when it comes to inflation is every time so far that we've seen mortgage rates fall, we've seen an increase in demand for people wanting to buy a house. And so now let's play this out. If mortgage rates hypothetically were to fall to, say, 5% tomorrow, what would you see happen? Chances are a lot of people are going to wake up saying, maybe it's time for me to go out and buy a house now because mortgage rates are finally falling. And if we start to see more people start to go out and make offers on homes, you can start to see more bidding wars on houses. And if you start to see more bidding wars on houses, house prices could go up even more, which could make the inflation problem worse again. Again, nobody knows where home prices are going to go next year or the year after that, but what we do know is that the price of a house is dependent on demand and supply. When you have more sellers than buyers, that can generally push home prices lower because when everybody's trying to sell their home and nobody wants to buy, the sellers have to compete against each other by cutting the home price. But when you have more buyers than sellers, everybody wants to buy a home, but there's no inventory of homes available for sale. Now the buyers are fighting against each other by bidding wars, offering more money, which pushes home prices even higher. And so what we have seen up until now is that as mortgage rates fall, demand also goes up. But here's where this gets tricky. And I know this is going to seem very confusing, but lower mortgage rates can also increase supply. And the reason why is because we have a lot of people that are sitting on homes that they own right now with a 2.5% mortgage rate. And they're saying, I don't want to sell my house because if I sell my house today at a 2.5% mortgage rate, I got to go into a new house and pay 6.5% or 7.5%, which is really expensive. And so maybe we'll just stay in this house a little bit longer. So these lower mortgage rates are actually one of the reasons why supply is still very low. In fact, take a look at this data. This is from the second quarter of 2024. 21.6% of outstanding mortgages had an interest rate below 3%. 34.5% of mortgages had an interest rate between 3 to 4%. 18.4% have a mortgage rate between 4 to 5%. 9.6% have a mortgage rate between 5 and 6%, and only 15.8% of Americans with a house have a mortgage rate locked in at 6% or higher. That means you have about 75% of homeowners in America who have a mortgage with a mortgage rate of under 5%. And for them, if you have to go out and buy a new house at a 6 or 7% mortgage, it's more expensive. And this is where some people are hoping is that if mortgage rates go down, yes, demand will go up, but maybe supply will go up as well. The question that nobody really has an answer to, everybody has a guess, everybody has a prediction, what people don't have an answer to is if mortgage rates were to actually fall, would supply outpace demand or would demand outpace supply? Because if demand outpaces supply, meaning more people go out to buy a home with a 5% mortgage than people that want to sell their house, then home prices are going to keep going up. If supply outpaces demand because now everybody starts selling their homes because it's a 5% mortgage and not many people want to buy a house, well then maybe they'll push home prices lower. But what we've seen up until now, again, this is up until now, things could change in 3 months, but up until now, the lower mortgage rates have meant that demand has been outpacing supply, which is one of the reasons why home prices are still going up, even though we're starting to see an increase in inventory. But the increase in inventory is still not anything super drastic to shift the housing market to a very drastic level. And this is why I say 2025 is going to be a very interesting year in the economy. And this is why it's going to be a very interesting year when it comes to you building your wealth, which is why I'm hosting this wealth building workshop on January 7th. I would love to see you there. Again, the link for you is down in the description. But this is where, again, the key is understand what's happening, not get caught up in the emotions, and understand how you can build wealth, save money, and continue investing your money, because that's where the opportunities are, and do not get caught up in the emotion. Let's assume that you make $5,000 a month. After taxes, you will be left around $3,833 a month. Now, when you get this $3,833 a month, you pay your rent, you pay your mortgage, you pay your groceries, you pay for some nice stuff here and there, and then you have no money to save and invest. So this is what we're gonna do differently.